Okay, welcome back. Um, Executing a trade. So, first step in executing a trade is to choose a broker. Um, and so you can do this in several ways. Um, there are several types. The first type being a full service broker. So these brokers not only execute transactions for you, but they offer a full array of brokerage services like investment advice. And so brokers are going to charge fees on transactions. And usually what this means is if you have a full service broker, you're going to pay fees for the advice. A discount broker, however, it charges the lowest commissions, but they offer no service. They simply just execute the deal for you. Commissions have been driven down very low due to online e-trading. And so when you think about E-Trade and Scottrade and other types of online stock trading platforms, these offer very low commission discount broker options. What you pay the broker depends on a few things, the services the broker provides to you, but also the type of purchase that you make. So people prefer to buy round lots of stocks. And in the stock world, a round lot is in multiples of 100 shares. So if you want to buy or sell something that's not 100 shares, it's going to cost you more money in the form of a fee. And the reason is that this broker is probably not going to be able to find, say you want 75 shares. Well, most people are going to be selling round lots of 100 or 3,000, or that one I think we saw was like 30,000 shares at 21 cents. And so it's hard to piece them apart and find 75 units. So you have to pay that broker for the extra effort to try to get an odd lot, which is something less than 100 shared. If you have like a 250 share order, then you have two round lots and one odd lot. So you're still going to pay a fee to fill that odd lot. So once you've figured out how you're going to get the deal brokered, there are several different types of orders that you get to pick. Now, you might have remembered the guy in the video saying, I call the investor the dog, and the dog tells me what to do, and I just fill the order. Well, the dog is going to give him a type of order, and there are several different types. A market order is just an order to say, hey, go buy and sell at the security at the best price available. So that broker walked up to the kiosk and said, well, where is this stock at? And he said, well, it's 30,000 is the current offer at this price. And that's the best price available. And so the broker is going to try to get the best price. A limit order is an order for the broker to wait until a specific price. So if you want to buy a stock, you would put a limit order in at a low price. And you would say, okay, wait till the stock falls down to this price or less, and then buy it as soon as it gets there for me. A limit order to sell would be the opposite. You have the stock in your possession. Your broker is going to wait until the stock gets to a certain peak or certain height, the price, and then he's going to sell it at that price. And then there's a stop loss, which is a stop order. So you're going to sell a stock immediately when the price drops below a specific level. That is like a limit order to sell, but it will continue on throughout the day. So limit orders end, right? So to get an idea about what that might look like is let's take a look at the some of the S&P movers. So Colgate-Palmolive is making a climb right now. Of course, the market has ended, right, 4 o'clock. And so you saw that, started out early in the morning and then grew all day long. And so if you put, let's say, a limit order to sell when the price reached, let's say, 75.50 in the morning, then we would have carried along, and the broker you would have been holding on to your stocks, not quite there, and then about 1:30 or almost 2 o'clock, 1:45, the broker would sell your stock for you. Of course, you would pay them a fee, and it's a little bit more expensive to do these limit orders rather than to just do a market order. So let's say that you and somebody else have the exact same offer. So you're willing to buy the stock for the same price. You want to buy the stock for the same price, and there's only one seller at that price. So who gets the stock? Well, here's what the order of sale looks like. First, it's priority. So which broker or order arrived first? Say you both got there at the same time and you're still offering the same price. Then it goes to who is ordering more units. We call this precedence. Then, in the off chance that you and the other person are buying the exact same number of shares at the exact same price and your brokers got there at the exact same time, we do parity. We just split the shares between the two orders. Okay, so that's how the stock orders work. That's how you buy a stock. So now we know where it's going. But now we want to think about what we're doing when we're investing. And really, you shouldn't just be buying stocks randomly. Everything should be goal driven. So let's say that I wanted to, this is kind of a small idea, but like your retirement account needs to earn a certain interest rate. Let's suppose something smaller. I want to buy this party barge in 15 years. And so I currently have 2,500 to invest today, and I'm going to have $1,500 each year from some mowing lawns in the summer to invest each year. And the price of the boat plus taxes and other stuff is $48,000. This is what's important is I need to find an investment that has the interest rate that will get me to 48,000 in 15 years, right? Um, and so we could do this with a time value of money calculator. We've done enough of these now. I'm just going to give you the solution. 7.8% annually is what I need to earn. It's high, but I would need to find the correct combination of stocks, bonds, and mutual funds that will earn me 7.8% on average over that time frame. We are going to learn the combinations of stocks, bonds, and mutual funds that get us certain rates in the next chapters to come. But for now, just know that investing is about trying to hit a target rate given my risk preferences. All right. So how risky are you? Right? A lot of people want to say, okay, I'm willing to take risks. Well, let's see. I'd like for you to click on the balloon game here. If you've got the slide deck open, go to this balloon game. So what we're going to do here is I want you to pump the balloon. Every time you pump it, you earn 50 points. But you have to cash in your earnings because every time you pump it, the balloon could burst and you will lose everything that you got that round. It's going to be random when the balloon bursts, kind of like the stock market going up and down. You're going to do 5 rounds to try to score the highest total points that you can, and then we're going to talk about it. So, for example, see, I pumped it once and got 50 points. I could keep pumping, and it might burst and it might not, and then I can collect. So go ahead and pause the video now, do it for yourself, and then come back once you've finished your 5 rounds. Okay, once you've finished your 5 rounds, you can see how many pumps you took. The more pumps you took on the balloon, the higher risk you were taking, right? Because the balloon was more likely to pop, and you didn't know when it was going to pop. And then up here on this axis is how much total points you got. So you can think about this being earnings from your investment. If we look at the many, many people who have played this game, we see a very interesting pattern emerge. Those people who didn't take on a lot of risk and did very few pumps earned very little. However, those who took on a lot of pumps had the potential to earn positive. But what we see is those people down here who are very conservative never earned zero. Those ones way over here oftentimes found themselves not earning anything. So with great risk comes great reward, but also risk is all about variance, right? How likely am I to win? Well, you could lose very badly when you take on a lot of risk. And so this spread here, as we increase our risk, represents kind of what's going on in the stock market. You can take on a bunch of stocks that are really volatile, and sometimes you win and sometimes you lose. Or we can try to be conservative and take on bonds that don't fluctuate very much in their value and earn a steady amount with certainty, but you face a trade-off. So you just have to realize and be comfortable with how much you could possibly lose when you're investing. Okay, what we're leading up to in the next few chapters is the idea of a portfolio. You're not going to buy just one stock. You're not going to buy just one bond. You're going to buy a collection of these things. So a portfolio is a collection of investment vehicles assembled to meet an investment goal, your interest rate, given your risk preferences, right? If you think of an investment goal like funding retirement, and you need an 8%, 10%, 12% interest rate to get there, and you're not comfortable with that rate, you're going to have to revise some things in your plan, because you got to be able to be comfortable with the rate that you're at. At the same time, a lot of people invest too conservatively, right? We talked about that earlier on last class. The key to getting good returns and minimizing risk is diversifying your portfolio. And this is choosing securities for your portfolio with dissimilar risk return characteristics. And so this can be done in a variety of ways. One simple way is to not pick all stocks and to not pick all bonds. So, what are these things? Stocks, as we talked about earlier, are units of ownership in a company. When you buy a stock, you own a piece of that company. And you can vote on firm decisions, kind of like you're an owner. And there are some types of stocks where you cannot vote, but for now, you have some power in the company, and you are paid based on the gains of the company. Right? Company makes profits, you can be paid. However, you also share in the losses of the firm, so you take on some risk because if the company goes under, you lose your investment. Bonds, however, are liabilities of the firm. Bondholders are lenders that lend money to the firm. So there's not an ownership interest here, but bondholders are always paid first when a company goes under because they sell off all their assets and pay off their liabilities, and the bond is a liability. So it's less risky to hold a bond. And bonds usually come with a stated fixed interest rate, or they could have variable, but a stated interest rate. So you know exactly what you're going to earn each period. It's much less risky than stock, but the returns are much lower. Combining these two things allows you to have a baseline level of growth in your portfolio with the potential to have big gains. Other forms of diversification that we'll talk about going forward can be within stocks. So it would be incredibly risky, for example, to put all of your investments into one firm. I had some family friends that ran into some money when I was younger, and they invested all of that money into Polaroid. Well, what happened when slowly digital cameras emerged and then cameras emerged on cell phones to the film camera industry? Well, it went away, right? People just weren't printing pictures anymore. So they lost their whole investment because they didn't diversify. Rather, if you wanted to put some in Polaroid and then some in technology, and so invest in stocks across different industries, even if one industry dwindles, the other ones might still be going strong, and it's going to mitigate the losses you get because that one stock tanks. So diversification is about owning several different classes of assets, and that is exactly what your workshop is about. You're gonna do a very basic 2 investment portfolio in the Excel worksheet I provided you, and you're going to look at the difference in rates of returns when you diversify versus when you do not. A rate of return, your textbook talks about this, is simply the change in the value over the investment. So you bought it at its price at some time long ago. This is the value that it is today. And so we'll see what that changes by subtracting out the level that we invested. And then if it brought any income with it, we'll talk about later how stocks can pay dividends, and that can be a source of income, and bonds can pay coupon payments, and that can be a source of income. For now, in this workshop, you're going to ignore income. You're just going to look at the change in value of the assets. And so let's flip over here. This is what your asset allocation workshop looks like. You have $10,000 to invest in a portfolio, and I'm telling you to buy 70% stock and 30% bonds. And I'm telling you which stock to buy, and I'm telling you which bond to buy. You'll have to research them, because what you're going to do is assume that you bought them on October 1st, 2008. Then you're going to come down here and see what they're priced at today to figure out what your rate of return was on each individual asset and then the portfolio. And then what I'm going to force you to do is look at a different time period where the returns might be different and talk about the value of diversification. All right, guys, that's the last day. Study hard for the quest that will be open on Thursday at 8 p.m. until Friday at 8 p.m. You should focus on the lectures. I ask all of my questions from my lecture notes. The supplemental book problems are just to help you internalize some of the other internalize the material better and build up your tool set. But in terms of the types of problems that you'll see and the types of questions, they come from my slides and they come from the workshops. So give it a go, study hard, and have a good day.